Welcome to the Deep Dive. Today we're doing a really rapid but rigorous look at the current financial landscape.
Right.
We're digging into the reports and market dynamics from, the last few days in December 2025?
That's it.
And you've given us a whole stack of sources here. Fed maneuvers, tech stock volatility, you name it. So our mission is pretty simple. What is actually driving liquidity right now? And maybe more importantly, where are the biggest risks hiding?
It's a market defined by a fascinating, a real dichotomy. We have to start right at the foundation.
Okay.
Liquidity. The core signal, the thing we're tracking, is coming directly from the New York Fed. They've officially kicked off the reserve management purchases. The RMP, that's the technical anchor holding everything steady. For now.
Okay, let's unpack that immediately because RMP, that's a lot of jargon. I think many listeners are going to hear Fed buying treasuries and just, their mind immediately goes to one place.
QE.
Exactly. Here we go again, quantitative easing. So how different is this really from the QE we've seen in the past?
That is the absolute crucial starting point. And let me be clear. It is emphatically not traditional QE.
Okay.
The market gets this, I think, even if the result, more liquidity, feels similar. QE was, an aggressive monetary policy tool. It was designed to lower long-term rates, really stimulate the economy.
Yeah, and balance sheet, right?
Indefinitely. RMP, on the other hand, is purely a technical mechanism.
So what exactly is that mechanism then? What's it doing?
It's all about managing bank reserves. The Fed has a very specific plan. They've laid it all out, and it's focused on supplementing those reserve balances.
The cash the banks hold with the Fed.
Exactly. It's to prevent any instability at the short end of the market. Think of it like a plumbing repair operation.
A plumbing fix.
That's all it is. The initial schedule is for about $40 billion in short-term treasury buying, and the direct effect is seeing that two-year treasury yield holding so firm. It's in that tight little band, right around 3.46% to 3.50%.
If that plumbing was broken.
You'd see that rate spiking. It would be chaos.
That makes sense. So it's a technical fix, keeping the system running smoothly, not a giant push to stimulate demand.
Precisely.
But hang on. We're still talking about $40 billion. Isn't the market going to treat it like QE anyway? I mean, that's a significant injection.
And that's the philosophical debate, isn't it? We can circle back to that. But for now, the data suggests the market is buying the technical story.
How so?
Because if they expected QE, you'd see long-term yields plummeting. But the 10-year is holding its ground, right around 4.12%. So it creates this kind of technical calm, a background hum of liquidity.
But not excitement.
No, not excitement for risk. Everyone knows this money is for plumbing, not for a party.
So with that technical calm as the backdrop, how is the rest of the market behaving? You mentioned cautious positioning before. What does that actually look like?
It looks like a high-stakes waiting game. The big theme is it's a mix of very specific event-driven activity on one side.
The micro level.
Right. And then deep, cautious positioning on the macro side. You can see this really clearly in the VIX, the fear index. It's tracking in that 16 to 17 range.
Now, 16 isn't panic.
No, not at all. But it signals extreme sensitivity. Investors are positioned defensively. They're ready to react and react violently to any sudden news.
Sounds like you don't want to leave your portfolio on autopilot over the holidays.
Definitely not.
But if everyone is so cautious, how are the broad indices like VOO, the S&P 500 ETF, holding up so well? It's near $626. That seems contradictory.
It's a classic sign of market segmentation. The resilience you see in an index like VOO is often passive.
Just the mechanics of indexing.
Exactly, and the weight of those mega-cap tech names. But the money that is being actively managed, that's telling a totally different story.
Okay.
We're seeing a clear, measurable flow of funds into safety, specifically into high-quality short-term bonds and money market funds.
So capital's just sitting on the sidelines.
It's liquid, it's waiting, and it's being highly selective. People are not chasing VOO up to these levels. They're waiting for the picture to clear.
That distinction is so critical.
Yep.
Passive resilience versus active caution. And meanwhile, the US dollar index, the DXY, is pretty firm. It's sitting at 98.4, 98.6.
Correct. And a firm DXY just keeps the pressure on everything priced in dollars. Commodities, emerging markets.
Another reason to be cautious.
There's another layer of caution, yeah. If the dollar were weakening, you might see capital flow into riskier areas. But with a stable dollar, steady yields, and the RMP just handling the plumbing, it just reinforces that global wait-and-see approach.
Okay, let's pivot to the other side of this dichotomy. If RMP is the technical calm, the real event risk is somewhere else.
Yeah.
And this is where it gets really interesting for me. Why are tech and crypto seeing so much amplified volatility? Let's start with tech.
With tech, the volatility isn't broad-based. It's surgical. It's focused on one stock and one piece of regulatory news. All eyes are on NVDA, trading in that 176 times to $181 range. The reason for the laser focus is that the risk here is entirely geopolitical. It all revolves around the H200 export license.
Right. And for anyone who isn't tracking the minutia of chip exports, just remind us why the H200 is such a huge catalyst.
The H200 is, well, it's basically the next generation engine for AI. It represents the entire future of global AI infrastructure.
And NVDA's dominance in that space.
Precisely. So regulatory approval for its export is a direct measure of the geopolitical temperature and, of course, future revenue. The stock isn't reacting to earnings anymore. It's reacting to political certainty.
And what's the latest data on that? How's the market reading the tea leaves?
Well, reports are saying the procedural review has started, that U.S. officials have begun discussions on, potentially allowing conditional exports.
Which sounds positive.
It sounds like forward movement, yes. But here's the key insight. Regulatory uncertainty is still the main driver. The news that discussions are starting is now completely baked into that $176 to $181 price.
So the market has already processed the possibility of approval.
Exactly. So if the possibility is priced in, the risk isn't just that the news is bad, it's that the news isn't good enough.
You don't get a bump from a procedural review.
No. You only get real upside if two things happen. First, clear, smooth, unconditional approval. And second, verifiable, major international orders flowing smoothly. Any hiccup, any delay or restriction, that's where the downside risk is.
Okay, that clarifies the NVDA risk perfectly.
Yeah.
Let's shift gears to crypto. If NVDA's volatility is about geopolitical regulation, the volatility in digital assets seems older, more fundamental.
No, it's pure old-fashioned financial fear.
Right.
The crypto market sentiment is firmly in the extreme fear range. We know this because the fear and greed index is reading around 20.
20, that is deep pessimism.
It is. And you see Bitcoin, BTC just consolidating. It's chopping around in that, say, $85K to $90K range, currently near $88K. Ethereum ETH is near $3. The big players aren't dumping, but they're definitely not buying aggressively either.
So if the majors are just consolidating, where's all the volatility coming from?
It's coming from leverage. It's a dangerous feedback loop between high leverage positions and the subsequent liquidation events, especially in the smaller, less liquid assets.
Okay, break that down for us. What does high leverage in an extreme fear environment actually mean for you, the investor on the other end?
It means small moves cause massive forced sales. When the fear and greed index is at 20, liquidity is just, it's gone. It's very low.
So it's hard to sell without moving the price.
Exactly. So if you use high leverage, say 20x, 50x, a tiny 2% drop can wipe out your entire position. It gets liquidated. And when that large position gets sold automatically, it pushes the price down even further.
Which triggers the next guy's liquidation.
And the next, and the next. It's a cascade, a domino effect.
So small moves feel like massive crashes.
They are. That's why the contract risk is so high. The market is basically waiting for a washout event before institutions feel safe coming back in. Until then, it is a very dangerous place to be using perpetual contracts or high leverage.
Okay, let's tie this all together. We've got the RMP providing a stable base versus this intense event-driven risk in NVDA and crypto. What's the strategy for navigating this?
Priority number one has to be liquidity and risk control. The market is not rewarding high-risk plays right now.
So cash is still king.
Cash retention is paramount. The Fed is fixing the plumbing, yes, but they aren't solving the geopolitical risk or the leverage risk.
And for broad markets, for VOO or QQQQM?
Stick to the discipline. Build positions via staggered purchases and only on the dips. Chasing prices when they're being held up by passive flows, it just increases your downside risk. So, patience. Use any volatility as a strategic opportunity.
What about those high volatility assets, Bitcoin, Ethereum, in this extreme fear environment?
Small positional exposure only. And given the fear and greed index and these liquidation cascades, my advice is to strictly avoid leverage.
No perpetual contract.
Just avoid them. The risk reward is terrible when the market is hunting for margin calls. If you're going to hold the asset directly, it's an environment for holding, not for leverage trading.
And finally, circling back to NVDA and the H200 news, how do you approach that specific risk?
You have to treat the current news as old news. It's disclosed, it's processed. Only add to a position if you see two things: verifiable new orders materializing and official confirmation of a smooth regulatory approval.
And have your exit plan ready.
Absolutely. Apply a strict stop loss. If there are any regulatory setbacks or delays, you get out. The downside is just too severe to wait around.
That is a very clear, risk-first approach. So this deep dive really shows the Fed is providing a technical fix with RMP, just injecting reserve to smooth out the system.
That's right. They're focused on stability, not expansion.
But the big question, the structural one for the coming weeks, is this philosophical divide that every investor needs to track. Is RMP just a temporary patch, a technical supplement that gets unwound later? Or does this start to function as a kind of quasi-expansion, a long-term shift that means the Fed's balance sheet is just destined to grow again? That division of opinion is where the real macro debate is going to happen next.
Exactly, and the execution details of the RMP, the pace, the counterparties, the market reaction, that's the data that will tell you which side of that debate is winning. That's your roadmap for the next quarter.